Hi, good evening everyone. I'm Komal Tyagi from Team Taxman and I welcome you all in today's live GST session, ITC on promotional items and ITC denial on non-payment of tax by supplier. I would like to start with a brief about Taxman first. Taxman is the leading publisher on tax and corporate laws in India. We also maintain the largest and the most accurate online database on GST, income tax, international taxation, company and SEBI law, IBC, FEMA banking and NBFC, competition laws, accounts and audit, and Indian acts and rules. Over the years, we have worked strenuously to offer the solutions that will continue to help you grow your practice. Our 6 decades of experience in the domain has helped us to constantly innovate and enhance our services to take the tax practice to a new height. I also welcome our learned speakers, Advocate Rahul Tangri and Advocate Amar Pratap Singh from the Lakshmi Kumaran and Sridharan. Advocate Rahul Tangri is heading the Lakshmi Kumaran and Sridharan Kolkata office and has an experience of more than 12 years in providing efficient tech solutions to companies, both from an advisory and litigation point of view. Sir regularly represents clients before various high courts, CESTAT, VAT tribunals, etc. And Advocate Amar Pratap Singh, partner in Lakshmi Kumaran and Sridharan, with more than 13 years of practice in taxation. Over the years, Advocate Singh has successfully argued matters before the Honorable Supreme Court, High Court of Punjab and Haryana, High Court of Himachal Pradesh, and High Court of Jammu and Kashmir and Ladakh. He extensively deals in matters pertaining to GST and other taxation laws. Now, before we proceed, here are a few tips for our audience. Firstly, your mic will be on mute. However, you may post your queries in the chat box given in your right hand side. The questions will be answered by the speakers during the session or after the session by the R&D team. Further, a copy of this presentation shall also be sent to you in email for your future references. Now, without taking much time, I request Advocate Rahul Tangri to address our audience. Thank you. Over to you, sir.
Good evening, everyone. Thanks, Komal, for the introduction. The topics for today's discussion, as already stated, are ITC on promotional items and denial to bona fide purchases. I would be discussing on the first topic, that is ITC on promotional items. In this, I would largely be discussing various types of promotional schemes, legal position regarding the eligibility of ITC on such schemes, challenges which the companies may face while availing such credit, and key areas of concern which need to be addressed so as to mitigate these risks. So starting with the discussion on various promotional schemes. The manufacturers and suppliers of goods come up with various types of schemes, some of which are passed on invoices along with the goods, while others have to be separately passed on after the goods are supplied. So these can be said to be on-invoice schemes and off-invoice schemes. The on-invoice schemes largely include minimum purchase quantity schemes. That is, here there would be supply of certain free items in case my customer purchases certain minimum quantity level. For example, if a customer purchases 100 units of a product, I may give him 5 more additional products on the same invoice. Then there may be a supply of 2 or more products in conjunction in a single invoice, which is called combo product scheme. Then there may be buy one get one scheme, which is also called free gift scheme. This scheme may contain the same product or different products. For example, with a pouch, with a one pack of shampoo, the company may offer another pack free, or like with one bottle of cold drink, the company may offer chocolate free. So these are the schemes under which the promotional items are given on the face of the invoice along with the main products. Now, there may be certain off-invoice schemes also, like target-based FOC scheme. Under this, if the dealer achieves a certain target of sales turnover, then he would be entitled to a free item at the end of the year or on a certain periodical intervals like 6 months. For example, if he achieves the turnover target assigned, then he may get a free laptop or iPhone or refrigerator at the end of the year. Or he may get certain extra post-supply discount at the end of the year. Certain gifts may be passed on to him by way of certain scratch card schemes. Some cards may be given to the dealers who are achieving certain sale targets. Whatever item appears in those cards, he would be entitled to that item. Or in certain cases, on achieving targets, the company even take their dealers on domestic or foreign trips. So all these are the various types of promotional schemes which we are likely to discuss in this session. Apart from these schemes, the companies also incur expenditure on certain promotional items like brochure, display materials, signboards, glow boards, etc. to create the brand awareness, and these products, these brochures, etc. are given to their dealers, distributors, etc. So we'll also discuss whether the ITC is eligible on these items or not. To understand the admissibility of ITC on such items, let us go through first through the legal background of the relevant provisions involved. The provisions relating to ITC are covered under Chapter 5 of the CGST Act, which starts with Section 16. Section 16 is the general section which provides for admissibility of credit on all the goods and services which are used in the course or furtherance of business. So this is the general provision. Section 17 puts certain restrictions on eligibility of the credits. The relevant provision for us for the present discussion is 17(5)(h) of the CGST Act, which restricts the ITC on goods lost, stolen, destroyed, written off, or goods disposed of by way of gift or free samples. It is important to note that here only the goods are covered in this restriction and not the services. Though services cannot be lost, stolen, destroyed, written off, etc., but definitely these can be given off by way of gifts, which we'll discuss in the later part of the session. So this restriction of 17(5)(h) applies only to goods and not to services. Then this here it's important to note what is the purpose and purport, which is very much clear with the wordings of this provision itself. That is, all those events and transactions which are not adding to the output tax liability of a supplier, legislature does not want to give the credit of those transactions and events, any goods involved in those transactions and events. Further, the concept of composite supply and mixed supply would also be touched upon in this session. I would deal with the relevant provisions when the relevant discussion comes regarding the combo offers. Schedule 1 of the CGST Act provides certain list of transactions which will be deemed as supplies even though they are undertaken without a consideration. Entry 1 is relevant here, which provides that disposal of business assets without consideration where ITC has been availed. This entry reinforces the concept of nexus between the input and the output. In case I availed input, then the legislature wants the output tax also from me. It is important to understand whether there is any linkage between section 17(5)(h) and this entry 1 of the schedule 1. On a cursory reading of these provisions, there appears to be an overlap and there appears to be a linkage between two. However, if we delve deeper into the provision, it would appear that these provisions are for different purposes and have to be applied at different points of time, and there should ideally not be any overlap between these two provisions. 17(5)(h) is an outright denial of credit, a provision which restricts the ITC at the time when the goods are procured, because the point of time at which the ITC is, whether the ITC is eligible or not, is to be determined when the goods are purchased and have to be entered in the books of the supplier. Therefore, at that very point of time, I have to see whether these goods have been brought with an intention to dispose it by way of gifts or free samples or not. So, at that point of time, section 17(5)(h) would apply. As regards entry 1 to schedule 1 of CGST Act, it would cover the transactions of disposal of business assets on which ITC has already been availed. Therefore, In case I procured certain business sets with an intention to use it in the course of supply, further supply, because of which under section 16 I took ITC, and the credit was not restricted under section 17 also at the time when the goods were purchased. If subsequently I decide to dispose it off without a consideration, at that point of time the schedule 1 entry 1 applies. So these are the different provisions which have to be applied at different point of time and for different purposes. So there should ideally not be seen any overlap between these two provisions. Having understood these basic concepts regarding section 17(5)(h), schedule 1 and the basic provisions of ITC availment, let us delve deeper into what is the purport of the second limb of section 17(5)(h), which says goods disposed of by way of gift or free samples. The term gift has not been defined under the CGST Act. However, it is defined under the Transfer of Property Act, where it says that gift means transfer of certain existing movable or immovable property made voluntarily and without consideration. Similar definition is given in the common parlance by way of dictionary meanings, etc. Therefore, it can be said that where something is transferred purely out of voluntary considerations and without expecting anything in return or without any consideration, then only it will qualify as gift. And as a corollary, anything which is transferred under a contractual obligation, it would not qualify as gift. It would be a general commercial transaction. It won't be a gift if something is transferred as under a contractual obligation. In such case, where something is transferred under a contractual obligation, ITC should not be denied by taking recourse of section 17(5)(h). Now, the scope of this gift is also clarified under the various international jurisprudence, like Irish law, tax and duty manual. It gives certain clarity on the scope of gift, where it says that gift arises only when no consideration is received for it by the supplier. The moment a customer is required to pay consideration for receipt of such item, that would not be covered under the term of gift, even if the nomenclature is gift. The promotional items under buy one, get one scheme have been specifically mentioned and clarified that these should not be treated as gift under the Irish law. Further, there are a number of judgments of Supreme Court, Tribunal and High Courts under the pre-GST regime, wherein under various contexts of excise law only, it has been held that gift means something given without a consideration, and where the department wanted to tax these sale promotion schemes only and wanted to tax the value of the bonus articles which are offered free separately to tax and by allotting some different value to that, then the Honorable Tribunal in the case of Bombay Latex held that bonus articles which are offered free by the manufacturer are not really given away free, but their price is distributed over the price of the other goods charged for. Supply of free items is a sale gimmick. This is the ratio given by various courts, tribunals, etc. So with this background, we can arrive at whether there would be an eligibility of ITC under various sales promotion schemes, which we discussed in the first slide. Taking all these schemes one by one. First one is minimum purchase quantity scheme, as we already discussed. This contains those promotion items which are given on a minimum takeaway quantity. Suppose a customer purchases 100 units of a quantity on an invoice, 100 units of a product on an invoice, then 5 items are given free on the same invoice. Even though we may say that these are free items, however, it is understood that this is a form of a quantity discount, and the value of the free 5 items is already inbuilt in the price of the 100 items supplied. Therefore, these extra 5 items cannot be said to be gifts, and ITC should be eligible on that. Next is the combo product schemes, wherein a number of products are given for a single consideration on a single invoice. Certain products may be described as free in that. However, all the value of all the products is inbuilt in the price of the total product. So again, here also, the ITC on all the products which go into this combo packs should be admissible. Next is the scratch card schemes. Here, these scratch card schemes are little peculiar schemes. They may be linked to the achievement of sales targets or to a particular supply. They may not be linked to the supplies also. At times, the dealers, at times the manufacturers or a brand owners may come up with a scheme to honor those dealers who have been associated with the business for say last 5 or 10 years. So in such cases, these scratch cards are given to only those dealers without any linkage of any supply. At times, it may be linked with achievement of particular sales target, in which case it can be linked to certain supplies made in the past. Therefore, whether or not the credit on these scratch cards should be available or not would depend on whether the company is able to establish the linkage of the promotional items given under these scratch cards with the previous supplies or not. Further, even in certain cases, in certain schemes of the scratch cards, there may be better luck next time. When you scratch it, there is no item involved. Therefore, the department can take a contention that in such cases, these scratch cards are only giving incentives. So a customer who has purchased the previous products does not have any expectation, or there is no contractual obligation to necessarily provide something under the scratch card. So availing credit on the scratch card scheme is a very contentious issue and has to be properly determined on the facts and circumstances of each case. Then there are target-based FOC scheme. This is the off-invoice scheme which we discussed earlier. In case a dealer achieves a particular sales target at the end of the year, he gets a free mobile phone or a gold coin or a refrigerator, etc. So whether the credit of mobile phone, gold coin or refrigerator is eligible to the manufacturer or not, that is the question. Again here, the consideration of this free of cost goods is already recovered from the dealer at the time of the supply of main products. Therefore, the credit on the free item supplied should be eligible in this case. However, the chances of dispute from the department cannot be ruled out in this case. As regards the corporate trip incentive schemes, wherein after achieving a target, a dealer is taken for a foreign or a domestic tour, this is for purely business promotion expenses and no goods are involved in this case. Therefore, there is no question of any restriction under section 17(5)(h). There is no other clause also which prohibits credit in this case. This is a genuine business promotion expense and credit on this should be admissible. Further, the businesses may provide certain incentives in kind, like calendar diaries, keychains, etc., which are given during the festive season on a free basis without any reference to the previous supplies. These items have commercial value and are given without any expectation or any return and without any contractual obligations. So this would satisfy the definition of gift, and the restriction under section 17(5)(h) would apply, and the credit would not be admissible in case of these incentives in kind. Further, businesses may supply sale display material, signboards, glowboards, etc., which are given to the dealers for advertisement and brand awareness purposes. These materials may also include brochures, etc. These are not the business sets, etc., and we have not parted with any ownership in these. These are for general business promotion expenses. There is no gift involved. Whenever, in case these materials have longevity and have a good shelf life, whenever the dealership ends, the businesses take back these materials. So it can be said that this is a general business promotion expenses, and there is no question of any denial of credit in this case. Further, since no property in these assets has been transferred, So it does not attract even the entry 1 of the Schedule 1 of the CGST Act, as we discussed. Regarding this buy one get one offer, though it is covered under my previous slides when we discussed the combo products, but I have kept it here for a purpose. Here I want to discuss one important aspect. In buy one get one offers, there is a element of taxability involved. In the not only the ITC, but even taxability has to be seen in these cases, because we have to see whether these combo items would qualify as composite supply or mixed supply. If we read the definition of composite supply and the mixed supply under the CGST Act, composite supply only would cover those things which are naturally bundled in the normal course of business. And where the combination is not naturally bundled in the normal course of business, and certain items are supplied together for a single price, then that qualifies as mixed supply. In all these combo offers, like as we have discussed, like one bottle of shampoo will get one chocolate free, or with one refrigerator, one oven free. All these are not naturally bundled combination of goods. Therefore, these would qualify as mixed supply. And in terms of the provisions of Section 8 of the CGST Act, the rate this would be treated as a principal supply of that goods, which attracts the highest rate of tax. Therefore, while drawing these combinations, it is important to see as to what is the composition of the goods involved. In case the composition involves certain item which may be very low on value but high on tax rate, that would not be a very tax efficient model. So the risk of that entire supply being treated as mixed supply and tax to the highest rate of tax would always be there. Therefore, the combination needs to be properly decided. Therefore, it can be said that the marketing of goods is no longer a function of marketing team only. Even the tax function and organization is also required to be involved in formulation of these marketing schemes, so that the entire model is tax efficient. Having discussed the ITC implications on various schemes, it can be concluded that there is no hard and fast rule or a straitjacket formula or a provision which says that ITC should be available for so and so scheme by nomenclature and not for so and so scheme. We have to apply the law to each promotional scheme to arrive at the decision if the ITC is admissible or not. Important point to be noted is that the scheme should be clearly defined, and the contracts that we have with our dealers, etc., should be properly structured to provide for such schemes. We have to ensure that the intent of the scheme is clearly reflected in the accounting methods adopted by us. This would help us in establishing the intent or modalities of the scheme with tangible evidence before the courts in case any dispute is raised by the department in future.
See, I can't resist myself to ask you two questions.
Yes, sir.
See, when you are speaking, I am a listener, like other people who are there in the webinar. See, first thing, 17.5H says that if you are giving goods as gift or free samples, you are not entitled to ITC. That is one. So what is the method of reversal of this ITC? That is one. Or should I go to Schedule 1, Entry 1, where it says that disposal of goods without consideration is taxable, you pay GST. So instead of reversing ITC by applying turnover method, etc., is it not a workable thing for me that whenever I am giving gift of free samples, then I pay GST on those items, deeming what is the consideration as the value of goods which I am ordinarily selling in the market, deeming it as the consideration for this, and I pay tax. Is that not a workable thing for me?
Sir, taking one by one, gifts and free samples separately. As regards the gift, once I procure any item to be given as a free gift, as a promotional item, then I should not avail the credit on that in the first instance itself. Therefore, there should not be any question of any reversal at a later date. Because eligibility of the credit is to be determined when the goods are being received and not at a subsequent stage. Therefore, when I'm procuring something, suppose a manufacturer of soft drinks, when it is procuring chocolates to be given free along with those soft drinks, they should not take the credit per se. That very point of time. Okay, or suppose I'm getting some free gifts to be distributed on samples, etc. Then I should not take the credit per se at that very point of time. And as regards your free sample issue, sir, that is an industry issue, definitely. People find very difficult, particularly the manufacturers, as to how to reverse the credit on the manufactured item. So there,
manufactured item, Rahul, manufactured item can be given as free sample also.
yes,
It will go as a free sample in a case where you are giving it to your distributor or to a new distributor you want to appoint, etc., or some customer, retailer, etc. And gift would be given in a situation, say I have a live situation where a company is manufacturing sports goods. Now they have certain players who are on their regular, they have contracts with them, they are promoting their products. So any case, on a quarterly basis, etc., they are sending their product as gift to these players.
free samples.
Not free samples, they are not their customers. They are not buying their products. They are promoting their products, they are advertising for them, they are appearing in the advertisements. But company is itself giving them some goods as gift. So it can be both. Your own manufactured product can be going out as gift, or it can also go out as a free sample.
So in this case, definitely, if we can apportion some method as to how much input credit has gone into those goods, then we should reverse it. However, as we have dealt with number of clients in this on the same issue, so there is a difficulty in arriving at the exact number of input tax credit which can be apportioned to these goods. So an easy way out taken out by the industry in this case is to pay the output tax on these items by taking the open market value as the appropriate value. That would ward off any disputes also from the department, because anyways output tax is more than what inputs would have suffered.
See, so I end up paying more, but will a situation arise that the department will come to me and say that you should not have taken ITC. We are not concerned you have paid output tax. Provision says you are not entitled to ITC. You have wrongly taken ITC. Here is the show cause. This is what the department is doing these days. So that is a possibility.
Yes, definitely, that is a possibility. Then it has to be litigated on various arguments, which includes revenue neutrality, etc. May I continue, sir? Any further
Yes,
questions?
Rahul. Yes, Rahul. Please.
So having discussed all these key areas or points that we have to keep in mind so as to mitigate the risks, it is important to understand as to where these risks largely come from. There are certain advance rulings given by Authority for Advanced Ruling. I can say here in a lighter vein that AARs have issued AAR, that means Authority for Advanced Rulings have issued adverse advance rulings on these very points. There are these 5 rulings that I have put here: Page Industries, Moksha and Agarbatti, Biostat India, etc. In all these cases, various promotional items were there, which were provided by the manufacturers as a part of sales promotion incentive schemes, which we have just discussed earlier. All these rulings tend to deny the credit on one pretext or the other. At times where the rulings have held that these are not free of charge items, value is already included, then they have said denying, no, you have not charged any value to that. Therefore, what you have supplied is not a taxable supply. Therefore, on one pretext or the other, they went on to deny the credit. And in one of the rulings, the logic for disallowing was that no contractual obligation, no contractual document has been produced by the applicant to say that why the free item has been supplied, even though the schemes, etc., were clearly mentioned in the ruling. So all these rulings have been rendered, though we can say that these advanced rulings are applicable only on the person who has sought it. However, these definitely are a guiding light to the departmental officers who make the life difficult for the industry or the assessee under their jurisdiction. So, what we can have a takeaway from these rulings is on all those points wherein they have said that these are the shortcomings on the basis of which credit is not being allowed, those can be taken as a guiding light by us so as to properly structure our transactions, accounts, and enter into proper contracts or scheme documents, etc., which will help us in case any dispute is raised by the department, so as to distinguish these rulings in our case. This last ruling, particularly in the case of Kanhaiya Realty Private Limited, I would like to touch upon. This is the ruling wherein there was supply of the bonus item, not as a bonus item, but as a very nominal price. Suppose in case the if a customer buys 1300 carton boxes of hosiery goods, then he had an option to purchase a gold coin or say a refrigerator or an AC at rupees 50, which is a very nominal price vis-a-vis its actual market value. So the question before the authority was whether the credit on these gold coins, refrigerator, AC, etc., which is at nominal price, should be available or not. Here the authority held that these items at nominal price are not being given free gift. Therefore, they held 17(5)(h) does not apply here. Therefore, credit they have held is admissible. To this extent, the ruling is a welcome ruling. However, in the very next paragraph, even though the question was not posed as to what is the value of the items, the authority has gone into that question again and said that the value of, that is the nominal price of gold, which is being reflected in the invoice, is not the correct value. Since it is being sold in conjunction with the main supply, therefore the value has to be arrived at under section 15 read with 27, rule 27, because price is not the sole consideration. They have merely held so without giving any further clarity. This ruling lacks a lot of clarity because the fact remains that what price has been recovered by the supplier in this case is price for 1300 boxes, which is the main supply of goods, suppose 50,000 rupees, and 50 rupees say for gold coin or a refrigerator or AC. So the total price recovered by him is 50,050 only. Once the ruling had gone into the valuation issue, it should have also clarified that value in any case cannot exceed this 50,050 rupees. Even if some consideration has to be apportioned to this gold coin or refrigerator from the main item, it should be reduced from the value of the main item, because ultimately both these items are going at a price of 50,050 rupees in our example. So that clarity is missing in this ruling. Otherwise, this ruling for the first time allows the credit of input tax credit on these promotional items. With this, I conclude my portion of the discussion. I would request my worthy friend and my senior, Mr. Amar Pratap Singh, for the subsequent slides.
Thank you, Rahul. Thank you so much. I had some more questions, but maybe we'll have some time. We will take it up at the end of the session.
Sure, sir.
See, the issue that I'm going to take up is the subject matter of litigation, and currently also litigation is going on in different high courts with respect to this issue. Now, as compared to previous regime, the change which has taken place with respect to input tax credit is that now the condition is that you used or intend to use the goods in course of furtherance of your business. Then subject to certain exceptions, which Rahul discussed with you. And then in addition to that, they have prescribed certain conditions under section 16(2), which you need to satisfy. These conditions, I'll say that these conditions are a combination of the laws, the Sendwet credit rules and various VAT laws, which were there under the earlier regime. So like one of the conditions that you need to possess a tax invoice or tax paying document. The details are furnished in the return GSTR1. You have received the goods or services, which was there under Sendwet credit rules also. D is important here, which says the tax charge in respect to the said supply has actually been paid to the government. and E, GSTR 3B has been filed by the recipient. Now, if you look at all these conditions, there are certain conditions which are under my control. As a recipient of goods, when I'm purchasing goods from some person, as a recipient of goods, there are certain conditions which are in my hands. Like, I will get a tax invoice with the goods. I will also receive the goods. And as a recipient, I will be filing my return. 3B. One condition which is currently subject matter of dispute is that if the supplier does not pay tax. So A, C, and E, I will satisfy, no problem. They are under my control. But as far as D is concerned, whether my supplier has paid tax or not, that condition is required to be satisfied by the supplier, so it is not under my control. And if that condition is not satisfied, the provision says that you are not entitled to input tax credit. So we will go into further details that what are the intricacies of this condition D. Now, how do I satisfy condition D, whether the supplier has actually paid tax? Now, the government says that you check GSTR 1 and 3B. So I go to the portal and I check whether my supplier is filing GSTR 1. Yes, he has filed. Whether it has come in my 2A. Yes, it has come. Whether he has filed return 3B. 3B is the challan, which is now they have set to be a return. Whether he has filed that return. Yes, he has filed. All the three are showing there. And I say, okay, condition satisfied. He has paid tax. Therefore, I am entitled to credit. But here in these situations also, there are instances, live instances, because where department has denied credit. First example I'll give. Supplier has filed GSTR 1, but he has not reported my transaction. He missed to report my transaction. And he has filed 3B. So on the portal when I check, he has filed GSTR 1, he has filed 3B. But that credit will not come in my 2A in that situation. So there is somehow I can identify it has not come in my 2A. So therefore he has not paid tax. The supplier has filed GSTR 1. He has included my transaction. It is coming in my 2A. He has filed 3B also. But 3B, I can't identify whether my transaction he has paid tax under 3B or not. Because the figures auto-populate in 3B, but you can edit. So it is quite possible that 100 rupees he may have declared in GSTR 1 including my transaction, but he has paid tax on 90. So therefore I cannot find out, even though in my 2A it is showing, but I cannot find out that in my 3B actually he has included my transaction and paid tax. This is one practical difficulty which a lot of assessees are facing. Another difficulty is 3B GSTR 1 filed, my transaction included, 2A showing in the transaction showing in my 2A. He has paid tax 3B entirely, no problem. But the credit which he has utilized, that credit is incorrect, illegal, fraud. There may be different scenarios. Now in all these scenarios, the department has put the law, in fact, the law has put the onus on me that you are not entitled to credit. Tax should be actually paid. If I go to the previous slide, you will see the phrase actually paid to the government. Now I say actually paid to the government, whether it implies that it should be paid out of legitimate input tax credit by the supplier. How can I identify that that input tax credit was legitimately used by the supplier? I can't do it. So therefore, sum and substance of this discussion is that the onus which has been put on the purchaser under this law, the onus is very heavy. It cannot be discharged. Even though I may act as a prudent purchaser, I may check the credentials of the supplier, but still I may end up purchasing goods from people who, even though on the portal they are showing that 3B has been filed, but they are not paying tax. They are not declaring entire transactions. In these situations, what the department is doing, they are finding the easy way. Assuming you are purchasing goods from a trader, they are catching hold of manufacturers who are the recipient of these goods. and they are issuing notices to them, demand notices, etc., blocking of input tax credit. They are using Rule 86A to block your input tax credit, saying that in those situations we will not allow credit where the supplier has not actually paid tax. But the difficulty which the recipient purchasers are facing is that they are not entitled to credit. Now, this is not the first time that this type of issue has come. This type of issue has earlier also come under different laws. There was a similar provision under Section 92G of Delhi VAT Act, which I'll just read the provision. It says, ITC shall not be allowed to the dealers or class of dealers unless the tax paid by the purchasing dealer has actually been deposited by the selling dealer with the government or has been lawfully adjusted against output tax liability and correctly reflected in the return filed for the respective tax period. Now, Delhi VAT Act, under this provision, they denied input tax credit to purchasing dealers, saying that some dealer, etc., XYZ, they have not actually deposited the tax with the government. It may be a fake ITC scenario. It may be a case of non-filing of return. Now, the court said that this provision is arbitrary. You are not protecting a bona fide purchaser. A bona fide purchaser would be a person who takes due diligence, who exercises all due diligence when he purchases the goods. He ensures that the supplier is registered. Thereafter, he purchases goods from a registered supplier. And then you say that no, the seller has not paid tax, therefore ITC will not be allowed. The court said that this provision is unconstitutional and they struck down Section 92G. Matter went up to Supreme Court. Supreme Court upheld the judgment of Delhi High Court. Now, whether the judgment will apply to GST laws or not, let us look at it from two scenarios. One is that the court says, in Delhi High Court says, that what is the diligence exercised by the recipient of these goods. As a diligent, what should I look at? I should look at the provisions of law for exercise of that diligence, or I should look as a common man that what is available on the portal, etc. Say, for example, I will check GSTR1 filed or not filed, first I will check whether his registration is being continued, not cancelled, etc. Okay. Whether he has filed GSTR1, okay, he has filed. Whether he has filed 3V, okay, he has filed. These things I can check from portal, but 3V doesn't ensure that tax on my transaction has been actually been paid. 3V doesn't ensure that if somebody is filing 3V, it is from legitimate input tax credit. So this is the maximum diligence I can exercise. I am going beyond the law. Even GST law doesn't require under Section 16(2) that I should ensure that he is filing 3B. That is not the requirement. Or I should go and check whether he is filing 3B or not, or whether he has declared all the transactions in GSTR1 and all those transactions which were declared in GSTR1, on those tax has been paid under 3B. That is not the mandate of law. So as a diligent person, diligent law-abiding taxpayer, what I will do is I will check his registration. I will see whether the credit is coming in my 2A, because this is what the law provides. If 2A is there, I assume that yes, he is declaring my transaction. Then why should the onus of I satisfying that the tax is actually paid that fall on me? So therefore, in my view, if such type of situation comes, the best recourse would be to challenge this provision in court of law. Unless and until you challenge this provision in court of law, it will hang on your head like a sword. You can't get away with this. An officer will not go beyond the provision and say that I'll give you relief. One more important aspect here is that what approach the department is taking is that instead of pursuing their case with the supplier, it is the supplier who is bound to pay this tax. He has not filed his 3B, he has not deposited tax. It is the supplier who is liable to pay. Instead of pursuing their case with the supplier, the department is issuing notices to the recipient. Therefore, the first thing that should be said is that the department should pursue their case with the supplier first. If they are not able to recover from the supplier, then only a situation will arise that they will come to the recipient of goods. Now, interestingly, though we are going by Supreme Court has affirmed Quest merchandising and they have affirmed that judgment, but there was one view by Bombay High Court where Bombay High Court took a different view in this matter. And they said that no, if the law prescribes that this tax should be paid by the seller of those goods, and if the condition is not satisfied, you are not entitled to ITC. So therefore, the department is going to rely upon this judgment. When you contest this matter, they are going to rely upon Mahalakshmi Cotton, because Mahalakshmi Cotton also SLP was, the SSC's SLP was dismissed by Supreme Court. So therefore, this issue has to be contested in court. Looking forward, what I have already said, that 16(2)(c), it has to be tested in High Court. You have to take up this matter. It is pending in different high courts. One of the high courts is Madhya Pradesh High Court, where this issue is pending. And exercise diligence, show your bona fides. See, it can't be a situation that you collide with that person and say that I'm bona fide. That is an exception. The court do not agree with that. That is an exception carved out by Delhi High Court, by Punjab Haryana High Court, that if there is a collusion between the supplier and the recipient, then credit is not available. So that thing is completely ruled out. A thief cannot get benefit of these judgments. You should be a bona fide purchaser, and your bona fide should be shown through your actions, not through a statement that I'm bona fide. It should be shown through your actions. You have received the goods, you have made the payment through banking channels, you have done proper verification, you have identified that supplier was a registered person and the credit was reflecting in your two-way. If you satisfy these conditions, yes, you are a bona fide purchaser. That's all from my side. Rahul, if the audience wants to, I think they have already posted some questions in the message box. If you can answer some of these questions, they are pertaining to promotional items.
So I have already answered quite a few by way of private messages to the respective recipients. In case anyone wants to ask any question, there is one question put in by Mr. Vaibhav Shah. Suppose on the eve of Diwali, I am giving gold coins to few of my customers and my trade name and logo is imprinted on that gold coin. Can I say it is not a gift but are actually promotional expenses and therefore ITC is eligible? So sir, here again it would, if we apply the test that we discussed earlier, it would depend on whether this gold coin is being given to the customer on satisfying certain condition under my earlier contract with him or not. If I am giving it to him regardless of any condition under a contract, just as a free gift because he has been a loyal customer, etc., then I would be hit by section 17(5)(h). This would qualify as gift because it is not in return of any obligation that he has done for me. It is not under any contractual obligation. This I am giving it free to him. So ITC would definitely be available in this case. There is another question by Mr. Sandeep Sarogi. What will be the fate of ITC reversal on expired goods? Sir, this would get covered again under the first limb of 17(5)(h), which says goods lost, stolen, destroyed, written off. Because these expired goods would be required to be written off in the books of accounts, so ITC would be liable to be reversed on such expired stock also. Amar sir, there is one question for you. If we receive notice for reversal of GST ITC, and the seller not paid GST, what are the points to be given in support of our claim to the department? This is by Mr. A.S. Sundarajan.
The first thing you should tell the department is what is the action you are taking against the supplier. Whether you have issued any show cause notice to him or raised any demand against him, or you have directly come to me and saying that he is not paid tax. It can't be a situation that you recover the tax from him. First you recover the tax from me, saying that your ITC is incorrect, you pay this amount, and then you also issue an order against him, pass an order against him and make recovery from him. That is the first thing you should ask the department. And you show your bona fides that yes, I am a bona fide purchaser. Fight it out. It has to be, see, some issues, it cannot be settled with the officers unless and until the court comes out with some pronouncement. So somebody has to take a call and fight it out in court. Otherwise, what department is blocking your input tax credit? This is what their excising powers under Rule 86 say, and they are blocking your ITC. This is what they are doing if you don't agree with them. And one fellow I saw is written that whether this problem would not have been there if GSTR 2 and 3 would have been there. Yes, to some extent it would not have been there. But we don't live in utopia. The government imagined that in 2017, their law which they are enacting is a utopian law, and yes, it ought to have been implemented in that way. But system doesn't support it. So still after 4 years, it is not there. GSTR 2 is not there, 3 is not there. They ideally wanted to implement it in that way. In that scenario, your figures would have been auto-populated. You would not have been in any case entitled to input tax credit, on which the other person has not paid tax. GSTR 2 would have been there, figures would have auto-populated in GSTR 3. Whatever he has declared, he would have paid tax, not paid tax, it would have been reflected on the portal.
There is one more question by Mr. Sumit. If we are giving gifts under the target schemes and claim ITC on the same, do we have to pay any output tax on the same, or should we disallow ITC on such gifts? Under the target schemes, in case on achieving a target by my dealer, if the manufacturer gives some gift to that person, to the dealer, then the value of that free item, which is being referred to as gift here, or a promotional item I should say, is already included in the value of other items that he has already purchased from me under the contractual obligation earlier. And since he has met the target under a contract, I am giving him this incentive. Therefore, this should not qualify as gift, and credit should be admissible here.
One more thing you should address here is that if you are giving two items, one item you are giving as a promotional item along with one item, and it is for your business promotion, no doubt you are entitled to input tax credit. 6(1) you satisfy. Whether in that scenario, and you say that the cost of this promotional item which I am giving is already included in the cost of main item. One thing you should also tell that it is a mixed supply if they are two, because it is not naturally bundled supply to say it is a composite supply. So it will be a mixed supply. Then the rate of tax would be the higher rate of tax.
Yes.
That thing also you should explain.
Yes. That is why whenever we are giving the gifts, free gifts, etc., we should ensure that we don't give those gifts which are in the highest bracket of tax. That is what we discussed in the key takeaways in the second last slide, just before the advanced ruling slide, that there would always be a risk of all these supplies getting qualified as mixed supplies. Therefore, ideally, the gold coin, giving the gold coin because it attracts the lowest rate of GST, that is the best bet in these circumstances.
Rahul, what I suggest that we can ask the team in Taxman to compile these queries and they can forward it to you. So wherever it is possible, if you can answer them offline, I think that would be a good thing. Ma'am, that's all from our side.
Okay, thank you, sir. We shall definitely be compiling all the remaining queries and shall send you in email so that you can answer to the same. Thank you for this insightful presentation. I believe this valuable knowledge will definitely benefit our audience. I appreciate the time you took to prepare the subject matter for this webinar and precisely explaining it to our audience as well. I also wish to thank the participants for being so cooperative. Thank you all for taking time out of your busy schedule and joining us in this session, for making it a success. Though we have tried to reply to the queries raised during this session, yet in case you have any further questions, you may also send them to us in writing at sales@taxman.com. We shall be replying it after fetching the suitable replies from the sir. And thank you all once again. Have a great time ahead.
Thank you, ma'am. Thank you so much. Thank you, everyone.